Hello and welcome to Mint. I'm Nasreen Sultana.
Nazreen, we are live.
Hello, I'm Jayashree Upadhyay, and this is the Mint web series of Pivot or Perish. We're trying to decode all the themes and all the issues that have cropped up because of COVID-19. And today we're discussing everything about capital markets.
After COVID-19 turbulence in March, financial markets rebounded impressively as investors looked past the social and economic impact of the pandemic. Unprecedented stimulus policy response by global central banks, including RBI, are now beginning to see some economic recovery. In India, particularly, the number of active COVID cases is on a decline. And of course, the vaccine hopes of in 2021 is bringing lot of expectations in the market. And market, of course, have been on a run since we crashed in March. Of course, the run has not been even, and of course, there has been a lot of hiccups to understand the resilience of Indian companies and Indian markets in this situation. We are joined by a stellar panel. We are going to discuss about the big themes post COVID-19 and what are the big factors to look after FY21. So join me in welcoming our stellar panel. So to begin with, we have on the panel Kalpin Parekh. He is the President, DSP Investment Manager. Next up is Sumit Pathak, Digital Workforce Evangelist, IMEA Automation Anywhere. Joining us next is Krishna Kumar Karva, Managing Director, MK Global Financial Services. Andrew Holland, he is the CEO, Avendus Capital Alternative Investments. Nishal Maheshwari is the final panelist. He is the CEO, Institutional Equities at Central Broking. Gentlemen, pleasure to have you on our panel. Welcome to the show. So to begin with, the biggest crisis of our generation probably struck us in the beginning of this year. So what has it been for your company and how do you think we have fared in this pandemic and the crisis? If we can begin with you.
Can you just repeat that question, please?
Sure. So I was saying the biggest crisis that has struck our generation probably was COVID-19 in the beginning of the year. I wanted to know from each of the panelists is how has that struck your business and how have you evolved out of it?
Okay. Thank you for having me here. And like the theme of the panel, which is pivot or perish, I think the human race and markets have taken their decision not to perish, but to pivot. And like every part of evolution over thousands of years, every time there is an environment or a accident like this, the human race evolves. And I think that's at play right now in businesses, in economies, as well as in markets. So companies are re-evaluating their approaches. And particularly if I talk about our own business of asset management, the way we are running our business, I think it's a huge, transformation that's happening. So, all through in the last many years, while as businesses, we were always saying that we want to be a digital asset management company, and it used to be a huge struggle to do that transition and transformation. COVID has actually fast-tracked that entire journey. And what we may have achieved over the next 3 to 5 years, probably we will achieve in the next 1 year itself. So, I think organizations, and if I talk about my own business, we are repivoting ourselves to say that what should be the way of doing business efficiently, productively, always, not just because of COVID or post COVID, but what is a common sense way of running a business. And in our business particularly, it's all about reaching consumers at scale and at lower cost. And technology today allows us to do that on all dimensions of our business. So the fact that we're talking to this established panel also over technology and reaching out to your viewers, I think we are pivoting ourselves. Our industry is doing that. Till few days back, I do know that the entire industry 100% was operating from home, using technology, leveraging technology to raise money and to deploy money. And I feel personally that as an industry we are so blessed, unlike many industries which were struggling and challenged to run their business or run their shop every day. In our business we are able to run the shop every day, execute every day. We get investments from our investors every day. We are able to give it back to them, and our meter is running all through the last 7-8 months. So with a lot of gratitude, I feel our industry has been extremely blessed that we are able to manage people's money with a lot of responsibility and do justice to that. And one big learning for all of us is that end of the day, consumer is the king. And the last 7-8 months has highlighted the role of volatility. Every few years, when markets take things for granted and complacency sets in, market finds a way to teach us a lesson and say that volatility is always there. Respect that, be aware of that, and keep it in your risk management and your plan. So I think it's a interesting evolution for all of us. And as I said, keeping our consumers first, leveraging technology and repivoting our businesses to run more efficiently and to build more scale. And I think we are happy to see that transformation happening across our industry.
Absolutely. I mean, volatility is, of course, the second name of markets, and you have to ride the volatility to actually make some gains in the stock markets. So, Mr. Krishna Kumar Karwa, if I have to ask a question to you, what has been your, how have you pivoted in this situation?
See, human beings are always resilient, and in every adversity, they find ways and means to survive and grow. And initially, when the lockdown was announced and when it was decided that we'll have to work from home, we were just wondering how it will happen. But then technology has played a big role, and seamlessly, we have all shifted to working from home. In fact, the revelation has been that sometimes you wonder that do we need to come to office every day? The business has been running so smoothly, and efficiency levels has been as good as it was earlier. Also, I think what has happened is that in terms of reaching out with technology, the way we are conducting this webinar, I think people have realized that the ability to reach more clients, more consumers, the time that has got saved because we don't need to travel, the
Yeah.
efficiencies have gone up tremendously in the last 6-7 months. Many of these learnings obviously will continue to go forward even after the COVID crisis ends. So that's a very big learning. In fact, we have had cases like based out of Mumbai. Most of our sales teams, etc., are all based out of Mumbai. But we have had cases where many of our research analysts, many of our salespeople have been working from outstation, not from Mumbai, and efficiency levels were equally good. So that has just changed the whole dynamics as far as how business will be conducted going forward. There is a distinct possibility that many of our team members may want to work from outside Mumbai, and we will be more than happy to give them the opportunity to work from their hometowns, etc. So that's a very big learning. In fact, we have done some placements, etc., where we have not even gone and met the promoters. I think all has been done over Zoom calls, and the placements have been done successfully. Again, it shows that the corporates themselves were more than happy to interact over Zoom, etc., and happy to give mandates and successfully execute such mandates. So we also had a conference of 150 odd companies, which is normally a physical conference, which is done over a 3-day period. And this time around, it was a virtual conference over a 5-day period of 150 odd companies. And seamlessly, the participation was at least 2 times more than the normal participation that we could have imagined. So I think the whole dynamics of running a business has changed. A lot of savings are visible, the way business is conducted. There are some challenges also, because at the end of the day, our business is a touch and feel business as far as the team is concerned. You need to have that locker room talk, if you can say. So that
Yes.
some of it is certainly missing. So there needs to be balance over there. But having said that, I think the way the market has behaved, it just shows that we as human beings tend to just extrapolate the immediate into the future. In March, when index was at 8,000, 8,500, we were possibly thinking the worst that could have happened. And now when the recovery has happened, again, we are very positive and gung-ho about the future. But somewhere the reality is in between. I think the biggest learning that we take from this whole crisis so far is that never get so emotional that you just panic or be over optimistic.
Right, absolutely. But as we are talking about, the way we are all probably pivoted, and maybe this is our bedrooms are new offices and our trading room. My colleague Becky has a question on the regulator part and on the technology. Where should we head?
Sumit, of course, over here, what we have seen, technology has played a really huge role in ensuring that the trading can happen from anywhere, whether it was from home or whether it was from any other remote location. Of course, this is the first time that has been allowed by the regulator, SEBI. Just to ask a question around the technology part, Sumit, and if I can ask the other panelists to reflect upon how the regulator has been helping out and easing the norms to ensure that the work continuity goes on.
Uh,
Sumit, hi. Firstly, the question is for you. If you could help us understand how technology has really helped.
Talking to me, right? Sorry, the name wasn't clear.
Right.
Yeah, thank you, thank you. So, see, I was before we started to broadcast, I was having a conversation with Mr. that what technology was always available. Okay, it was the instance that was somehow discovered. The capability to log into a VPN, to provide a secure connection, to connect to the servers and to work on it has been there for some time. It was the risk part, having being risk averse in the attitude, in the approach, was more of a mindset related challenge. Now, with because of pandemic, there has been a bit of a push, right? And we have been forced to work from home and use the technology, right? Does it mean that those risks have gone away? Does it mean that we are not looking at this risk closely? No, we are. It's just that now the mindset is okay. How do you make it work rather than okay, this may not work, right? So when you have that positive angle, how do you make it work? That's when you start looking at the approaches of how can I use my technology to be enabler. Okay, is that say for example, if I onboard a new customer, can all the paperwork of KYC can get automated using bots and digital workers and this sorts, right? So I think it's two things which we are seeing with our customers. One is the mindset change. The risk compliance infosec team more are now looking at being a partner and making them looking for solutions and how to make it work. And the second, it's, as Krishna did mention, that it's about making sure there is always a productivity there, and that's where technology is coming through as well.
Right. Mr. Holland, the question is for you because we saw most for the first time that the traders are working from home. Remote terminals have now been allowed, something that the foreign investors had been asking for quite a long while. Of course, the other part keeps coming in that the institutional trades. That how do you really ensure that the institutional trades can happen from home remotely with the safety, privacy, all those challenges? How have you addressed those, sir? Mr. Holland, you will have to unmute yourself, sir.
Yeah, I mean, all that's changed. And thank you very much for inviting me.
Sure.
All that's changed really is that the Bloomberg where you execute your orders is really going to move to your home rather than the office. So there's been, no change. Your risk limits fall out of that, into the system. So it really is you just replicating your desktop, into your laptop, into a different location. So the regulators, the BSE, NSE have done a great job in terms of making sure that there's no hiccups, everything was working. But day to day, in terms of putting an order through the Bloomberg hasn't really changed. Obviously, what's changed is having that team of traders and fund managers sat together to discuss the markets and the movements in the markets. And that's been the challenge at the beginning, was to if there's something moving in the market, if you're all together, it's very easy to say what do we think. But by the time you get onto a Zoom call or a conference call, the market's already moved. So that's been one of the more challenging parts to it. I think the other challenges is probably a little softer in terms of what I want to talk about. Is that I think we're all probably working longer and later than usual to some extent, and I think particularly for people who have families, as young families, having many families living together, there's a lot of not stress, but there's a lot of complications with that on a day-to-day basis. So I think trying to do some move back to the office in some form or other, I think would help ease some of that stress that people across not just our industry, many industries are facing. And I think that's going to be the challenge for HR departments globally, is how we do that nice mix of work from home, in terms of an office, because we can all get nice chairs and better computers, but we still have the challenges of cooking and cleaning and everything else that might go with it. So there's those elements which we tend to forget by saying technology has enabled that. Unless we get robots into our house, and someone else has to do that. Maybe that's the next stage.
Right. So to take the conversation now forward towards the other parts of the market in the terms of how they have been performing, my colleague Nasreen has some questions over there.
It's said that the rally that we have in the stock markets is a hope rally or an expectation rally, and these hopes are of course built on vaccine, definitely yes, and other things, that the economic recovery. I want to understand from Mr. Maheshwari, how do you see it? Do you see the rally to be sustainable now?
Thanks, Nasreen, for having me. I think from where we started in the month of April, after COVID hit basically, and we all were, it's sort of a doom kind of a situation. I think we have come a long way on. There is no doubt about it, basically, that still there is huge amount of uncertainty. But I think what along the way is basically the world has learned how to live with COVID. And if we look at it, basically, I think India was one country which had the maximum amount of lockdown, or the severest lockdown. And slowly we have opened up, and almost across the country now, we are from 75% to 90% kind of the opening up is. And this opening up, along with that, basically we've seen that the number which had run up to 1 lakh day basically has now come down to almost 50,000. So what has happened along the way is basically people have lived to learn with, people have actually learned to live with this. And this is what is also showing up in the market. So we are seeing a big hope rally which has happened. Now going ahead, basically we have to see whether this recovery which we have seen is only based on demand which was pent up, or this is more regular demand. I have my doubts about that basically, because I believe post this festive season, if the demand still continues, then we are saying that basically we are at pre-COVID levels and we have passed this summer. But I definitely believe there is going to be issues basically, because the numbers which have been put out, CMI claims that there are 55 lakh jobs which have been lost in the white collar alone. Blue collar number was also pretty large, and there is a large amount of unskilled labor basically, which must have lost their jobs along the way.
Right.
And in India, basically, if you look at it, the stimulus is not very strong.
Absolutely.
So this is all going to actually show up somewhere. It cannot be that this doesn't show up and basically the whole such a big lockdown has happened basically, and we still do not have a problem. So I believe we should wait out. I think the rally has been pretty strong, and we should wait out and see basically if the post the festive season, if the if the demand continues, then I believe there is still scope for the markets to go up.
Right. If I can throw this question open to Kalpin also, do you think this rally is sustainable? I understand there are challenges, but of course, the hope rally that we saw, Sensex and Nifty are almost, gone to the pre-COVID level. Both Sensex and Nifty are up around 60% from the March crash. This is not small number at all. And we, of course, compared with the other EMs. How do you see the rally now? Kalpin, you need to unmute your mic.
Okay. So see, Nasri, this is all about how we anchor ourselves. So if we anchor ourselves to March lows, then this rally looks overstretched. And if we anchor ourselves back to January highs, then we are broadly where we were. And in the last 7-8 months, what has happened is while earnings have been lower or revenues have been slower because of lockdown, but on the other hand, companies have very quickly exploited their survival instincts and significantly cut down on costs, and that is reflecting right now in the results that we see every day. We are seeing significant amount of margin increases because costs have come down. On one hand, either raw material costs have come down, or on the other hand, operating costs have come down. So straight away we are seeing significant margin increases. Now the question to ask is this a one-time change or is this sustainable? And I believe that once companies realize that we could have done business actually more frugally and more productively and more intelligently, like we are doing right now, and let this become the norm in the future. So to that extent, some amount of structural strength is coming back with one group of companies. But on the other hand, see, there are two things which is happening. The treatment has happened immediately, which is huge amount of liquidity which has got infused. But the healing will take time. So the medicines have been given, and these medicines are creating significant demand for stocks. But the healing of the economy and of corporate India and companies will have its own level 2 effect. And that is something we will have to wait and watch for. What is also happening is few large companies are becoming stronger at the cost of many small and mid-sized companies. So what we used to always talk about consolidation or transition to the organized sector, that again has got fast-tracked in this entire cycle. So few companies are polarizing most of the capital from investors in the market and reflecting in its market cap, and more companies will struggle. So level 2 effect, I would wait and watch for some time. But in a nutshell, can this rally sustain? I would not try and make a comment on the rally, but I would say that good businesses will sustain what they are getting priced at for two reasons. One, their operating efficiencies have gone up. The demand for the asset class is constantly increasing, and on the other hand, interest rates are very subdued. I think the bigger call to make is how long will interest rates remain low, and if I think that continues for long, then I think any valuation in equity markets is getting justified today.
Absolutely. Kalpin, you almost preempted my question, actually. There is a lot of, cautiousness among analysts that this rally is probably led by a handful of stocks. And actually, IT and pharma, these are the two sectors which have shown their resilience. And of course, the demand has had increased because of the work from home situation. I wanted to ask Mr. Karwa, do you think the other sectors like oil and gas, metal, power, have not participated in the rally at all? Do you see these sectors coming up and participating in the rally?
See, if you look at the broad market, if you look at the mid cap, small cap indices from January, they have outperformed the Nifty. So there has been a broad rally which has taken place in the market versus what we have seen earlier. So the rally has been very broad based, and it is not only the IT sector or the pharma sector which has participated, but what we have seen is a rally across sectors. So we have seen the auto sector also doing equally well, specialty chemicals also equally are doing well. FMCG companies have consolidated. The sectors that you mentioned, which is metals, I think metals are have already done well, and if there is a global reconstruction, etc., or spent in infrastructure, which is expected across the globe, and already we are seeing that China is doing that. So we have seen the metal stocks have done very well locally and also globally. And if there's a massive stimulus package coming in from the government in the coming months or years, then obviously your metals will continue to do well as far as the sector. Power sector is a sector which is a with a limited returns kind of a scenario, and where the PSU stocks are more prevalent, and they possibly are not in favor with the investors. They are more value stocks as of today, and unfortunately, value which was 2 years ago has become more valuable today. So there is a lot of value which is there in those stocks, but there is hardly any follow up by investors in those kind of stocks. To allude to your point further on this interest rates, I think liquidity and being what it is globally, and the way even RBI in its recent policy has talked about providing liquidity to the system, whatever is required. I think interest rates are expected to be low for a longer than normal. That's and more than that, I think as far as you mentioned about the rally itself, my sense is that today the whole way people invest is narrative investing. If there is a story, then only those sectors do well. Because you mentioned about power, there is no story in power today. Investors are not interested. You mentioned about IT. There is a massive story about next 2, 3, 4 years that there are tailwinds for that sector. That is why the valuations or the stock prices are doing well. So I think narrative is very important. If we get the narrative right, then there are whole host of sectors. So whether it is the banking and financial services sector, there was not a strong story in that sector for the last 6, 7 months. But today, after the RBI policy and after the one of the private sector bank majors have talked about their results, etc., the story is building up that possibly the worst is behind and financials will make a comeback in the next financial year. So my judgment is that investors should be very cognizant about what is the story in the sector that they are investing in. If that is right, valuations, as you rightly said, interest rates, if they remain low, then valuations, historical valuations will not work for you. That's my take.
If I can ask you about, again, this entire issue about how technology is going to keep playing a role as we go forward. We have the cloud technology, which has really helped in the data storage, data security, data privacy, because at the end of the day, financial services is all about data. If you could take us through that.
Actually, I think I lost you in last 10 seconds of your question.
Right.
It was just me, or it was everyone?
Okay, Sumit, I'll just take you through that question again. Just to
Yeah.
understand that how do we maintain the data privacy and data security for financial services, which is one of the key elements because so much of
Yeah.
money is riding there.
Yeah, sure. Let me first, if I can take the liberty of sharing a story, based on Krishna's point. What we are seeing with our customers, and because when the pandemic was brought upon us, it didn't come in one shot on the globe, right? It started in China region, and then it went to various different parts of the world. And as it's abating and just is settling down, we are seeing various different trends coming out from different countries. Like, for example, we are seeing that in China, the sale of car is going up, right? So, which means that it has taken those that industry by surprise. So there are two parts to it. One is that when the pandemic came upon us, there was a bit of a shock. Now, when the dust settles down, what will be the new thing that will come up, and are the organizations basically ready to basically respond to that new change which is coming up, right? So if the car demand is going to go off the roof, the automobile industries, ancillary companies around it, are they pretty geared up or not for that? So that's something which we have seen our customers are now looking at digital workers to help them to go through that particular spike, right? So that's something I just thought I will share from the conversation which we have here. Talking about the security, see, the products, security is paramount. You cannot compromise it. The technology is out there, be it 256 with encryption, TLS 1.5, or it could be, the cloud computing, right? So the way technology has now been designed, if I will give you an example, since the pandemic is here, we have seen a massive upscaling of cloud customers. Everybody wants to get onto cloud, right? For two reasons. It makes it scalable and it makes it resilient, right? And the model is becoming more of a pay-as-you-go model rather than a monolithic one saying that, okay, I want to invest heavily into one client architecture sort of investment rather than it is, infrastructure as a service, cloud as a service, and other sorts. So while these technologies are being brought in, the security is still at the forefront of it because you do not want any data to get compromised. But to also understand, like for example, automation engineering or any similar sort of products, right? They don't store any data locally, right? So it's all stored in the cloud of the particular organization, and it is transferred with a very, very heavy encryption, which is a bank-grade encryption to say, and that's why it's very difficult to break. And now we have seen over the 8 to 9 months, right, that this is working through VPNs, through having that security in place, data being transferred, and data being on the cloud as well. And it's, I think the uptake itself is a proof that the organizations are getting comfortable with such technologies.
Right. Mr. Holland and Mr. Pari, this is a question for the two of you. Of course, we have seen the kind of inflows that have come into the markets and the role the institutional investors have played. How do you look at India as an economy? How does it go on from here? And so second, again, Mr. Parekh, again, this question is for you. We have seen quite a number of challenges for equity mutual funds as well as debt mutual funds. So that is another thing that I will like to touch upon with you. If I can start with Mr. Holland, please.
Yeah, so I think a few things on liquidity and for India, where's the economy? But before I get to India, I think one of the big themes I think is going to play out over the next 3 to 4 years, and it's really kind of as a result of the pandemic as well. It's what you've seen now is that China's really has done a V-shaped recovery. It actually is showing growth. It's not rebounding. It's not getting back to where it was. It's showing growth. And it really tells you then, the countries who have kind of managed to put a lid on the virus in terms of the number of cases are now starting to see, that V-shaped recovery very strongly. And if you get a vaccine coming through, then obviously that just accelerates everything for these Asian countries, which are seeing very low rates of growth more recently. So I think, the next wave is going to be Asia. Growth. People, offshore are going to be saying Asia's the place I need to be. Obviously led by China, and I think that's going to bring a lot of flows, portfolio flows, into emerging markets, including Asia. And India's weightage in that is obviously very high. So we're going to get our own fair share of that. So that's the good news in terms of the flows, the passive flows that will come to India. But India as well, I think I think Reliance has single-handedly put us back on the world map as the place where there's going to be growth, and I think everyone has forgotten that. And if there's a vaccine, the pharma industry will do exactly the same because we're going to be manufacturing a lot of these vaccines. So I think these two things put India back, and all the measures that the government's taking, whether we think they're too slow, whatever, to make in India tariffs, trying to force manufacturing companies locally and multinationals to manufacture the parts here and have full supply, plus whatever's coming from the trade disputes with China, US, and COVID, all bodes well for foreign direct investment to come through massively over the next 3 to 5 years. And that's not just a multiplier effect for the economy, it's also going to be for jobs and everything else. So, I'm looking at a brighter future. There's lots of volatility in between time, I can assure you of that. But I think the long-term kind of theme is that money's going to come to Asia. The dollar's going to depreciate against Asian currencies, including the rupee. And the RBI is single-handedly, in my view, doing all the heavy lifting. It's put the balance sheet of India in such the strongest position. Import cover 19 months, reserves 570 billion. If there's a rainy day, if there's another shock coming, we're ready for it. They really have done a brilliant job. I'd love to see the government do more, but I understand that. Why spend money when the economy is going to anyway be a U-shaped recovery? We've only just started coming out of most of the lockdown. So there's time to do that, and maybe that time is next year, not straight away. So I think so I think when people look at the economy for India, they understand it's going to be a V-shape, but they've seen part through a reliance on farmer industry, the Make in India, and now the new wave that will come into Asia as being part of that. Let me put it a different way. There's 58 million millennials in the US. In China and India alone, each country has around 328 million. You know where the growth's going to be over the next decade or so.
Sure. Sure. Mr. Parekh, again, the question now for you is in the terms of the challenges that the debt mutual fund industry faced in the month of April, May, which has been really turbulent. And after that, we saw back-to-back changes also coming into regulations. I mean, if the last count, I think about 10 odd changes have happened only for the debt mutual fund industry. So this is kind of a paradigm shift. So both on the aspects of, are we out of the challenges for the debt mutual fund industry? And secondly, whether these changes are coming at the right pace or they're coming really soon, very fast. These are the two questions I have.
See, I've been investing in debt funds for almost 23 years now. I passed out from college in '98, and one of my senior was in the fund industry, and she made me do my first investment in a debt fund. This was in '99, and because the investment was a small amount, somewhere it got lost. When I looked at my account statement very recently, I realized I've earned around 10.5% return in a simple debt fund with largely sovereign bonds and blue chip bonds, AAA corporate bonds over 22 years. Now, over 22 years, 10.5% compounding without significant volatility, I think is a very good outcome for the fixed income part of my portfolio.
Right.
And why did I say give this data point or statistic to you? Is over time we've seen the usual ups and downs that every asset class goes through. I honestly will not call it a challenge because this is an inherent part of the volatility of every asset class. So when interest rates go up, bond prices will come down to some extent, and maybe for a month or two the NAVs will be stagnant. When credit cycles change once in every 5 years, there will be some amount of hiccups that would happen. What tends to happen is that we tend to put a lot of limelight for that one particular month or 2 months and label that asset class as a very challenging asset class, whether it is equity or gold or fixed income or likewise everything. I just want to clarify that all of these are an inherent part of our of any asset class. It's like when we breathe in and out, our body will move. You can't say it is volatile and there are so many challenges around you and let's try to fix the patient. It's not a bug. So I just want to clarify again that these are all phases of every market and every asset class. There will be ups and downs. If an investor believes that I will get a straight line return and still make 10% return, whereas the risk-free rate is 4% return, then I think that is challenging. To me, the challenge is not the temporary fluctuations that we have seen in fixed income. Number one. Number two, I think we are very happy that our regulators have been responding at lightning speed in periods like this, wherever something needs to be fixed to ensure orderly behavior of the market and to ensure that the investor interest is paramount. I think every changes that we have been seeing in the last couple of quarters or even over time are very quick response to the changing patterns of where risk is emerging from or where volatility is emerging from. And I think a lot of regulations have been done with learning from the last cycle, that how do we keep on ensuring that the industry is far more stable, far more transparent and relevant to the end user. Today, the transparency that you see in the mutual fund industry is at a different degree or a different extreme. Tell me which investor today can know that when I'm putting my money in a bank deposit, where is that money getting deployed? But if you invest even 500 rupees, even 100 rupees in an equity fund or a debt fund, at the end of every month, you know where every single rupee is getting allocated. So I think immense amount of transparency, immense amount of competitiveness, ensuring that everyone tries to do things which are better for the investors. Of course, I'm not dismissing the fact that some accidents did happen over the last 2 3 years in the industry, and it is our fiduciary responsibility to ensure that we govern risk and manage risk and liquidity with the right amount of prudence, and these are all learning points. But I think even within that, if the fixed income category in the industry is around 14 lakh crores, all the credit accidents happened in a category called credit funds, which was 50,000 crores. The balance 13.5 lakh crores, like clockwork, every day has been giving liquidity to investors when they wanted, with market returns. I would just urge you and investors to recognize the concept of market returns. Mutual fund is a market product. Do not expect a linear straight line return every day. And for that non-linearity, if you're getting compensated by some extra returns, I think we're doing our job. Can we do it better? Of course, every day we can get better, and the competitive environment will, make us better and better. And the second question was in terms of, do these asset classes make sense? In my view, these asset classes make permanent sense. COVID or no COVID, volatility or no volatility. Different asset classes are meant to fulfill different needs for an investor. Inflation, equity is for long-term, inflation beating. Fixed income is for intermittent. It's like a seat belt which allows us to navigate the volatility over a long period of time. If we as mutual funds are able to communicate the benefits of these asset classes in a simple way to your listeners and to our investors, I think we will continue to showcase the value of each asset class and create value for your investors.
Nasreen, any follow-up questions?
Yes. So as we are talking about mutual funds, this rally also brought in a new set of investors in the stock markets, and this is not an Indian phenomena; it is global phenomena where retail investors have actually rode the rally. They have come in bulk, and they are actually staying here. My question is to Mr. Karwa and Mr. Maheshwari: how do you see the influx of retail investment or the retail investors here? And there is also a fear that the retail investors are kind of taking few unrealistic calls. There are a lot of stocks, penny stocks, as we call them in stock markets. They have done a robust rally in the last few months. Do you think it's a bit of concern?
Yes, there has been massive increase in the retail investor participation, and I think it has been driven by two, three things. One is obviously the cost of doing business on discount brokerage platforms has come down tremendously. People were at home also without maybe not going to offices, so that also spurred. But I think this is a phenomena which is there to stay because two, three things. One is today the ease of doing business is very high. The cost of doing business on the markets is very high. Thirdly, the young generation, and they have been regularly investing in mutual funds also. But the thing is that in the last 5 6 years, the returns have been below par for many of the investors. So probably they have decided to take matters in their own hands also to see for themselves that can they do better than the investment that they have made through managed accounts. So that's a different. So it's going to be there. Having said that, I think also the thought process now amongst the investors is that if they're looking at more from an asset allocation perspective, which is that overall what is their investments in various asset classes and overall what is their returns. So somewhere the thought now in the minds of investors is to invest more in ETFs than actively manage funds. So there are some structural changes which we are possibly witnessing. One is direct investing, which is there to stay, and the other is the thought process about investing more in ETFs, apart from obviously investing in actively managed funds also. So there's distinctly thought process in the mind of investors to diversify the instruments that they are investing in.
Right. What about you, Mr. Maheshwari? What do you think? You think the retail investors probably are not guided, not matured in their stock calls, and probably taking a very taking position in stocks which do not have fundamental support.
So I think my view about this is more of a fad actually. You are there was, as Krishna was saying, there was ease of doing business. There is zero brokerage. There are a lot of accounts basically which are giving you this kind of a zero brokerage, and there is a lot of time at hand. So people are actually doing. People are actually participating in this. But as the market becomes more volatile, basically they will realize that it's a very difficult game, and we have to give it to it. Basically, that even mature investors, basically, or seasoned mutual fund managers, if they are finding it difficult to give you returns over a sustained period of time, and I'm
Absolutely.
not talking about 1 or 2 quarters, 1 or 2 quarters, yes, you will be able to outperform. But I think sustained period of time, if you are able to, if fund managers are finding it difficult, it's very difficult basically for any individual to actually do these kind of things. We have seen this thing basically in the late 90s, early 2000s. There was huge amount of personal participation in the Indian markets also. But slowly, as the mutual funds became bigger and they were able to educate people, I think people found out ways basically, and
Right.
I'm saying this is going to go back there. This is just a fad, actually. I think world over, basically, this is going to go down as people find their regular job
Right.
and go back
So
to
Mr.
offices.
Maheshwari thinks it's a fad. What about you, Andrew Holland? Do you think that this is the flux of the retail investors in stock markets is just a fad and will probably go away as we go back to our offices?
Yeah, I'm not sure if it's a fad. I mean, it depends. See, I think you can only really test this if the market was to fall, 10 to 15%, and there's a lot of pain, particularly in mid and small caps. That's when I think the test will be. And that's been, not just for India. That's globally the kind of, what would happen there. So, I think, in any kind of scenario when markets have moved up quickly, you usually say that the last one to invest is a retail investor, and therefore you should be worried. I don't think that's the case this time around, because markets, we could argue, are still on a long-term basis still reasonable value. But the first test, I think, will be when markets fall, and there's some pain kind of unleashed on some of these investors, whether they have the appetite thereafter to continue or go back to their normal way of investing through mutual funds or SIPs or whatever they might do going forward. So yeah, and there's obviously some element markets have helped you, but once you have that that view of that you also like to invest yourself, I think we should kind of encourage it through education rather than just say it's a fad, because if you can get people to learn more, understand more, it could only help their understanding of the markets and companies, and make them better investors, as we all hope to be better investors ourselves, right?
Right, right. There's also a lot of excess liquidity in the stock markets now. We know that global central banks, whether it is ECB or Fed, they have been pumping money into stock markets, in the equities, and that's why probably we are seeing a bit of foreign institutional money coming in India. And of course, DIs are on the back foot now. I have two questions to everyone on the panel now. Is if there is this excessive liquidity goes out of the stock markets, if the global central bank starts unwinding their balance sheet, do you think the rally will continue? And if so, what do you think we need to look beyond FY21? They're just 6 months to complete this year, and we'll be getting into FY22. Budgets will come up, a new current budget will come up. What are the big themes you think we should focus now? If we can start with Mr. Krishna Kumar Karba.
So, looking at the severity of the negative GDP growth across the globe, I don't think that liquidity is going away in a hurry. If you hear what the RBI governor or US Fed, etc., whoever has spoken, it looks like this liquidity and this low interest rates is there for probably more than a few years. But
Right.
having said, even if whenever the US Fed decides to unwind its balance sheet or increase interest rates, what does it mean? It means that growth is back. From a capital market perspective, what is important? It's important that we grow. So my sense is that okay, there will be temporary hiccups whenever interest rates move up, but if it is accompanied with good growth in economies across the globe, then I don't think so that there is any challenge as far as the capital markets are concerned, because ultimately investing is all about growth. Now coming back to your second question about where to invest in. Domestically, if you look at it, my sense is that what we are seeing in the real estate sector, we are seeing tremendous pickup in the real estate sector, driven by low interest rates, stagnant prices for the last 5, 7 years, and the supply today is reducing, and the brands are able to do very well. My judgment is that this sector is coming out of maybe 7, 8 years of stagnation, and economy continues to. I mean, if it picks up and it continues to do well in the next few years, then this is one sector that one should be looking to invest in. Obviously, the disruption that we have seen and because of internet and the e-commerce. So in India, listed space, there are very few opportunities that you can play the disruption to the e-commerce place, etc. But there are a few listed stocks, and so those are the areas that you should be looking to invest beyond 21, because that's technology at play. We have seen technology can do overseas, and we have seen it over here, but the listed plays are limited. But if you can invest in some of those stocks, I think that should do very well.
All right.
Be positively enthused with
Hmm.
the farm sector reform that has been unleashed.
Okay.
And if we are looking beyond FY21, the opportunities over there in terms of when corporate India enters food processing and the allied sectors, that could
Hmm.
be a very good opportunity for investors.
Okay. What about you, Mr. Parekh? Do you think real estate or farm sector are the big bets beyond FY21? Your mic is off, Mr. Kalpin.
Sorry, I make the same mistake again.
No.
Yeah, so I think what we have identified is a couple of durable themes coming out of this cycle. Themes like personal mobility, things like healthcare and more hygiene related, or even insurance as a theme where consumers have realized the value of these structural products and segments. Particularly on real estate, I do feel that it can be a dark horse. One, because for many years the theme has not done well. Significant amount of consolidation is happening. A lot of regulatory transparency has been introduced there. And lastly, you realize if we are going to work from home for a longer period, a lot of consumers would want to now have a better house. Like I myself realized in the last 6 months of lockdown that what switches are not working, what is the color of my wall, where do I need to fix some of these things. And I've for the last 12 years I've been living in a rented house because in Mumbai the rental yields are 2%. I
Yeah.
always feel if bond yields are 7 and 8%, and if broadly return on equity for corporate India is 11 or 12%, why should I buy a real estate at crazy valuations? But with the fact that some amount of price correction has happened in various pockets, and right price points, I think in India the demand for real estate is massive. The challenge is the right supply, the right configuration, the right transparency, and affordability. So if affordability were to improve with interest rates coming down on one hand, demand is not an issue. In fact, the demand was always there. It will only accelerate a little bit more. So real estate could be a dark horse, and more than real estate alone, because there will be very few solid companies where you can really put your money in terms of good governance and balance sheets. But a lot of other ancillary industries which are into the home for, space, that those industries also will get an advantage to that. And your first question was on liquidity. I think I've always said that flow has become a very important fundamental parameter apart from fundamentals. So in the last many years, flows have really determined the acceptance of an asset class. So if liquidity were to shrink and if interest rates were to rise, today at almost zero interest rates world over, it is as good as gravity is zero. And when gravitational force is zero, everything starts putting up. So if that cycle were to revert, and I don't know when will it, I don't have expertise to judge that. But if rates were to rise, gravity will come back, and some impact on valuations will happen, which over time will impact the returns from the asset class. So in my view, while growth is at an all-time low and will look for some amount of inflection as it normalizes, but even valuation should normalize at some point if interest rates were to rise and liquidity were to come down.
Right. So we've got home, we have got insurance, we have got consumer durables. What's your pick, Mr. Andrew Holland, for beyond FY21?
So actually, real estate was one of my sectors
I'm
too.
very surprised that real estate is one of the most beaten down sector now, and that's one sector everybody's betting on.
No, but it's very simple, right? In that all the things. I mean, Calvin just very articulately mentioned that look at his own home. He might want to buy a home now, right? Because he might not need to live in Mumbai or close to the office or wherever he wants to be. He can live outside. He doesn't need to be there. And I think that's one thing. But I think if I asked all the panelists, 5 years ago or 6 years ago, would they expect to see their gross returns on a fixed deposit or a liquid fund of around 3% before tax? And I'm sure they'd say, no way, there's ever getting there. And so, real estate has been an asset class which we haven't looked at for so many years now. But I think people will, and I think they are. I mean, I'm sure that yield you talked about, Calvin, at 2% must be near to 3%, right? And 3% versus what you earn in liquid funds now. You can get an asset, a real asset as a house, and put it on rent. So the whole game is changing. Maybe it's not going to happen so quickly. But I think the pharma sector is the other industry which I think is going to be, again, they've done a lot of cost cutting over the last few years because they've had to change how they've done things. So, as the top line grows, it's all going to fall through to the bottom line because of operational gearing. There's a shortage of the kind of right drugs in the US, so that the generic companies get the pricing power back, which they haven't had for years. Which will take the margin, shooting higher as well. And then finally, if you get that vaccine and we're manufacturing, then I would have thought a multinational, pharma company is going to look at India and say, I need to get in there. What's the quickest way? I think M&A in the sector is going to happen as well.
Right. So till now, I've spoken to 3 gentlemen, no auto bets so far. I mean, there was a lot of conversation about, personal mobility after COVID-19. Let's speak to Mr. Maheshwari. Is auto your bet for FY22? Your mic, please.
Sorry. So auto has done well in the current year, basically, and I believe it's going to be there, but I don't think so. That's going to be an outlier, basically. So what I understand is what you are saying, basically, where you're going to make good returns and you can invest for the next 3-4 years. And my bets are basically technology. I think there is a massive wave, basically, which is coming across. And India is a part of it, basically. And this is a multi-year story which is happening, basically, as far as technology is concerned. So this is not one-off of 2 quarters or 3 quarters. This is a massive run, basically, for 3-5 years, basically, we're going to make. And some of these stocks, maybe multi-baggers from here is what I'm telling.
Right.
So technology is one. The second one is, I agree with Krishna, basically, about e-commerce. I think that's another massive one, basically, which is going to happen. If you look at it across the world, it's happened. It is going to happen in India. And we have several of these companies out here. Your Flipkarts, Amazons, a lot of them basically are there here. And those companies are now doing massive business. So they will all get listed to unlock value. Right. The other thing which I like is the outsourcing. Across the world, basically, we look at it, China used to be the manufacturing hub across the world, but slowly it is losing its charm because of various reasons. And I think India is definitely out there, which is going to take advantage of that. We have already seen it in case of chemicals, and we are going to see it in several other industries actually where India has an advantage. So I think outsourcing is another very big one basically which I would want to play. So I think these are the three things basically which I look at it for multi-year investments. Beyond 21, I'm saying these are themes basically which will play out in the next 3, 4, 5 years.
Right. So, Sumit, I'm sure you're very glad because Maheshwari picked up IT for FY21. I thought that's a sector nobody's going to pick up after the kind of rally that we saw. And there's a lot of, people have already taken position. This sector has given good returns for a lot of investors. What's your pick for FY22?
See, it's after the experts have spoken, I can't add anything on top, but I'll give a different view to it, right? From what we are seeing in the market is whatever the volatility be in the market, right? There's always you create an opportunity out of it. And for example, in the pandemic, when it came through, the automation anyway, we divided that into three different segments. The industries which are to be efficient, the ones which needs to survive, and the ones which we need to save, right? And this philosophy will be there post-pandemic as well. So for example, your pharma, your healthcare, your hospitals, right? They need to be efficient because the demand's gone off the roof, and then you need to bring technology in to help them to cope with that particular demand, right? And Mr. Maheshwari spoke about outsourcing as well, and processing is part of the outsourcing, not only manufacturing, which is a big part. When you move from being efficient to survival, we know that hospitality industry has been significantly impacted, right? And how do you keep the lights on? How do you basically reduce that particular operating cost when you're the top line? If the cash flow crunches there, how do you keep a positive jaws? In that case, again, we are seeing technology is being used as an enabler, which is coming and rescue them from that particular space and giving them opportunity to diversify and come with a new type of services, right? So that's what we are seeing. And same at insurance sectors, banking sector, they're too big to fail. They need to be saved, right? So again, we are seeing that. So zeroing down in the end, it is about no matter which environment we are in, the industries will respond differently. But at the bottom of it, the foundation, the technology will be there to support them in the way they react to it, either to survive, either to scale.
No doubt, Sumit, be it home buying or be it insurance buying, technology will have to support. So, gentlemen, before we really wrap up, we have time to squeeze in one question. Jayashree, take it away.
So just to take the last issue, because this entire theme of the entire discussion is pivot or perish. So for all of our panelists, if we can just get one key takeaway from you, that which are the kind of firms that will survive and which of the firms will perish. So if we can start with Sumit, with you first, because you are the automation expert.
As I said in my previous comment, right, I think they won't, so we have to make the opportunity out of the crisis. It won't be perish, but it will evolve into something different. So I won't give a name to an industry, but every industry will find their own way to come out of it and will transform. So I think that's my response.
Kalpit, if I can ask you the same question.
Companies which are consumer obsessed will survive and adapt and thrive. What I feel.
Mr. Karwa?
I think the big is becoming bigger. So my sense is that the firms which are maybe mid-size or small, they need to figure out how they have to become big, because it's very difficult for the small firm to survive. That's my
Mr.
take.
Maheshwari?
I think the winner takes all is the situation out here, and I think just be with the leaders, because in this kind of a situation, in every downturn we have seen, the leaders stay with the market share, and I think the fringe players are basically. I think I agree with Krishna what he's saying. The big will become bigger. Basically, that's another way to look at it, and that's what the market is rewarding also.
Mr. Holland, what is your take on the same question, sir?
So my take's slightly different in that I think the principles of ESG are going to come more and more to the fore. If you look at the US market, right? I'm not saying these companies have perished, but you could say that they could do, right? It's if you look at the performance of renewable stocks versus oil stocks. It's like that. Obviously, oil stocks have been falling. So there's going to be a big wave of change. And those companies which are not ESG compliant will perish. That's for sure.
That was a very interesting take, Mr. Holland. I think, Nasreen, do you have any subsequent question on that?
Yeah, I think we're running short of time. It's already about 7, and it's a really insightful conversation, gentlemen. Everybody on the panel, thanks for giving us time, and a pleasure to have all the insights about your respective, industry that you represent. Thanks so much.
Thank you.
Thank you.
Thank you, everyone.
Bye.
Thank you. Thank you, everybody.
Bye.